How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to discuss with you the differences between an IUL versus a 401k. Now, when we get started, more common type of retirement account is a type of 401k. And we understand that this is known as a qualified retirement account, meaning that it's qualified through the IRS, through the government, as deemed for retirement income at a later date, or some sort of retirement account that you could access at a later date. So a 401k plan is set up through a private institution. If an employee is working for this institution, for this private company, they might be offered this type of 401k account. What it is, simply put, is an individual has dollars that they're getting paid, a salary every single year. Let's just say it was $100,000. This person now has the option to take a percentage of his salary and place it into a type of retirement bucket. So let's say if this person is placing 5% of his salary into his 401k plan, well, then we understand that $5,000 is going into this type of 401k retirement. Now, there's a couple different things. Some companies like to incentivize somebody to stay at that company, so they may offer them a match, such as like a 2% match or a 1% match. And that means that if somebody's making $100,000 and they have a 2% match, if they put in $2,000, which is 2%, then the company's going to match them 2%, $2,000. If this person's putting in 5% into their 401k and they have a match of 2%, well, then that means that the company's only going to match them $2,000. So therefore, you have $7,000, working as a contribution for that specific year. So it doesn't go by how much money you're essentially placing into that bucket, but it goes by the interest credit that's also being associated with this type of retirement bucket as well. So if this interest credit, and typically a 401k is tied to mutual funds that are tied to some sort of stock market. So you have a mixture of stocks and bonds that is set up, that is correlated to this type of 401k related account. So if somebody's placing in thousands of dollars into their 401k related plan, and let's say that the market's going up, it's going up, it's going up, it's going up, and then all of a sudden you have a downward shift, you had all these gains, all these contributions into this account, you've accumulated $100,000 into this type of 401k related account, and then all of a sudden that year the market drops 50%, like it did in 2008. The average portfolio dropped 57%. Let's just say if it drops, 50% in a given year, which is a little bit extreme, but it's a very realistic scenario. It didn't matter if this person was accumulating their money, they was placing dollars aside. Because of this negative interest credit, it completely depleted their retirement account, their retirement, their retirement bucket, their 401k related bucket. So therefore, their $100,000 starting off the year would now be down to $50,000 at the end of the year. That's a really bad thing regarding 401k related accounts, is because they're typically tied to mutual funds, and a lot of times those mutual funds, they don't have plentiful options. Meaning, with the 401k account, yes, you're offered some sort of retirement account through your company, it's employer sponsored, but typically they're limited the amount of mutual fund options that you could choose. So it might be 5 to 15 different options. Out of those 5 to 15 different options, if the market goes down, majority of the times your account's going to go down tremendously. So, they don't really have that high of quality of mutual funds within those types of 401k related accounts. Now, why is that important? It's important because if your account goes down, if the interest credit comes back negative, well, then your account is essentially going to be negative, is going to be split in half or drop down 10% or whatever it was. It didn't matter how much money you were placing into that bucket. It mattered by how much were the fees associated with that 401k account, with those mutual funds, and then essentially what was that negative loss to your type of retirement bucket. So you might have heard something, let me clear off the screen, and individuals might have heard something known as an IUL, an Index Universal Life Insurance Plan, or a 7702 plan that they could essentially leverage as an alternative to contribute to their 401k. They could essentially attribute it to a type of Index Universal Life Insurance product that is designated to maximize out the cash value to then receive tax-free benefits at a later date and time. The problems with the 401k account are you have limited types of mutual fund related in there. You have mutual fund related fees associated with that account. You have 401k related fees associated with that account. You have downward market loss associated with that account, meaning if the market goes down, you could essentially participate in what that loss is. And then on top of it, you have something known as a 59.5 rule, which says if you're accumulating your money into this 401k related account, you cannot pull your money, you cannot take money out of your 401k account before the age of 59.5. If you do, you're going to be heavily penalized, meaning 10% penalized, and get fully taxed on that money, as well as every time that you try pulling this out, if you try pulling it out before 59.5. So if an individual wants to retire before 59.5, they're kind of caught between a rock and a hard place, because it's going to be very difficult on how to set that up properly. With an IUL, and when set up properly, because understand IULs, there's many times that these things are set up completely, like complete garbage. So you have a lot of different fees going towards the actual agent, towards the actual company, and the individuals are leveraging their plans the wrong way. So something with our agency, Afasi Financial Group, we have access to all the top IUL carriers out there, proprietary to setting up max cash value accumulation. You have hundreds of different contracts out there that are set up with index universal life insurance, and out of those hundreds of different contracts, I might recommend maybe 3, maybe 4 companies for an individual situation if they're looking for cash value accumulation. So what exactly is IUL? How can you set this up to make sure that you're getting these types of tax-free benefits, making sure that you're not limited towards your funds? You don't have the downward market loss associated with it. You don't have mutual fund related fees associated with this. You don't have 401k related fees associated with it. And most importantly, you could retire because there is no 59.5 rule associated with these types of accounts. Well, if we're looking at permanent life insurance, and a lot of times you might see, be your own banker, or you might see different concepts that try to hone in on the benefits of cash value accumulation. With a typical life insurance policy or permanent life insurance policy, an individual goes and places premium dollars into a type of plan that is associated to a death benefit. Remember, life insurance, you have to have a death benefit with life insurance, or else it's not deemed life insurance. So there has to be a type of death benefit associated there. For each dollar that you're placing in there, typically companies or contracts are set up where you have the majority of it are going towards the different costs of insurance, different miscellaneous fees that are going to suffice that death benefit in place. Saying, and a lot of times you have a life insurance agent that's going to say, okay, based upon what your current goals are, we want to make sure that you have life insurance protection, death benefit protection, and they're honing in on this death benefit at all aspects. The type of plans that I'm talking about do not associate the death benefit as the most optimal aspect. And why is that important? It's important because the higher that your death benefit is, the higher that your cost of insurance and miscellaneous expenses are within this type of egg shape. So if you notice, I left this little spot blank. What this spot is known as cash value. So with a permanent life insurance policy, how it's typically set up is that agent is trying to maximize what that death benefit is, tell you, 10 different reasons why you have to maximize out this death benefit. So then you're throwing thousands of dollars per year into this type of contract. Whatever is not suffice for that cost of insurance, whatever is remaining extra, goes into something known as cash value. So this cash value account grows by the amount of net that you've placed in addition to anything above what your actual expenses were for that year. So that's going to grow this, kind of think of this cash value as a bucket. So it's going to be that net amount that you're increasing year by year by year, and also the percentage rate, the interest credit that comes back as well. So if you have like a whole life insurance policy, you have something known as a dividend rate, which is typically a fixed rate. An indexed universal life is tied to an upward stock market index. So what happens is everything additional beyond the cost of insurance and beyond what those miscellaneous expenses are, well, that's going to be netted into this type of cash value, and then the interest credit is going to be based upon if you choose like an S&P 500 or Dow Jones Industrial Index, whatever the case may be, whatever the contract may allow you to have. What it says is anytime that the market goes up, you're going to be capped at a certain limit. Anytime that the market goes down, you're going to have a floor of a certain limit. So rather than the 401k related plans that anytime that the market goes up, you're going to receive a gain into your account. Anytime the market goes down, you're going to receive a negative to your account. This type of cash value associated with it, let's say if you have a cap of 17%, and it's tied to the S&P 500, and the S&P 500 gains 20% that year, you're going to receive an interest credit of 17%. Anytime that the market goes down, let's say it loses 17% the next year, well, you have that floor of 0%, so therefore you're going to receive a 0% gain into your account. So what we're trying to do is make sure that you're always having the power of compound interest working in a positive direction to accentuate out that cash value further and further and further. Let me clear off the screen. There is a great importance of this cash value that allows you to supplement retirement at a later date. And what I mean by it is when set up properly, you could get certain types of tax-free benefits. You could have tax-free growth within this account every time that the market's going up. You're receiving gains into that type of cash value, and you're also receiving gains into the cash value every time that you're netting more than what those costs are. So your growth is going to be tax-free. When it comes time to pull out this money, you have to do it a very specific way, and this is one of the things that we specialize on, is because we deal with many, many individuals on a national basis that have set up their IUL plans properly and then have to pull this money out on a tax-free basis. So that's one of the things at any point in time that you're interested in these types of concepts, give our 1-800 number a call, and a specialist could walk you through how to set up these things properly. But you could receive income tax-free, and that income, you do not have to wait to age 59 and a half like you would with a typical 401k related account because it's deemed a non-qualified account. And then the very last thing is the death benefit. With a 401k, if you pass away in your 50s or your 60s, all of that money is going to be fully taxable to your beneficiaries based upon what their tax bracket is at that point in time that they're receiving that type of income. With these types of plans, because it's life insurance, all life insurance is deemed tax-free. So you have tax-free death benefit as well. Now understand these things, this is just the generic concept of how these things work. If we're looking at this old type of, traditional type of plan, a permanent death benefit plan, a permanent life insurance plan, I'm looking at this and I'm saying, all right, well, all the money that's being placed into this plan, you have a very large portion that's going in towards those expenses, that's going into the cost of insurance, those miscellaneous expenses. And why exactly is that happening? Well, it's happening because that's how, unfortunately, advisors and agents, life insurance agents, set up these types of plans. They try to maximize this death benefit because ultimately, if you're maximizing out that death benefit, then your costs are going to be as high as possible, and therefore the agent commissions are going to be as high as possible. If you have somebody that has $1 million death benefit, obviously that's going to be a lot more expensive with the different costs associated in there than somebody that has a $500,000 death benefit. With that same sort of premium payment that's being placed into that plan. So if you're interested in an IUL maximization plan or you want to do it as a 401k alternative, the most important aspect is to say, okay, what is the smallest amount? If you figure out I want to throw $10,000 a year into this type of plan or $12,000, $1,000 a month into this type of IUL plan, what we're trying to do is compute which is going to be the carrier that is going to give you the cheapest possible death benefit, the cheapest possible costs associated with that death benefit, and how can we make sure that that death benefit is as small as possible so that for every dollar you're throwing in there, you have the cost of insurance, you have all those miscellaneous expenses as tiny as possible, and now we have that cash value accentuated as high as possible. So that what we're doing is we're increasing that net that's going into that cash value. And then on top of it, we're choosing the best contracts out there that have the best indexing strategies with, the top, the best types of caps, the best types of floors associated with that, and making sure that we're squeezing out every bit of leverage, every dollar that you're placing into this plan. And what this process is known as, and the very important aspect of an IUL plan versus a 401k, is indexing versus averages. With the 401k, an advisor could explain to you, oh, well, your account average 0%, your account average 2%. Well, if I go and we're going off of the rule of averages, if you had an account that dropped 50% one year and then it gained 50% the next year, what would that account have averaged? That account would have averaged 0% rate of return, right? If we place a number there, and let's say that you took $100,000 and that $100,000 lost 50% the first year, and then it gained 50% the next year, even though it averaged everything on paper showing you an average of 0%, your actual rate of return was a 25% loss. So therefore, averages do not mean anything if not set up properly. Obviously, if you're getting a positive average, if you keep compounding your interest credit year by year by year, that's going to be a lot more powerful than something that could go up and then go down, then go down, then go up, because that average rate of return is not going to be your actual rate of return. With these indexing strategies through an IUL, we can make sure that it's tied to a stock market index. Anytime that that index goes up, you're receiving a positive interest rate on top of that cash value growth of what you're netting. Anytime that the index goes down, you're receiving either a floor of 1%, or a lot of times the best contracts actually have a 0% floor, saying that if the market goes down, well, then you're receiving a 0% gain that year. But you're not losing your entire cash value, that 1 year because the market went down. You're not associating any downward losses to that type of IUL related contract. So when we're doing a comparison regarding growth, income, and death benefit, we understand the growth of an IUL could grow tax-free. The growth of a 401k grows tax-deferred. The income of an IUL, when set up properly, could come out tax-free, meaning you could have tax-free income, kind of like how a Roth IRA works. The income of a 401k has to be fully taxable. There's a large, oh wow, that's very sloppy, I apologize. There's a large argument saying that, obviously we're in economic turmoil right now, and therefore in order to pay back all this national debt that we've incurred, that the government is going to have to increase taxes. It's just the inevitable. Unfortunately, if someone's placing in their retirement dollars into a 401k, the theory lies that why would you want to place something into a type of account that's going to be fully taxable later on when tax brackets are all-time lows right now? So therefore, they're starting to flock towards those IULs and towards those Roth IRA accounts to receive that tax-free income later on. When you have a death benefit, even though we're trying to minimize that death benefit as small as possible, there does have to be a death benefit associated with an IUL, because if you throw too much cash value, too many dollars at this without the minimum amount of death benefit, then it deems your account known as a qualified retirement account, and it's known as a modified endowment contract. So those are just some very simplistic terms to kind of understand, to grasp that you want to make sure that this is set up the proper way. Now, God forbid, if whenever you pass away, the death benefit in the IUL, meaning that there has to be a correlation, it's known as the cash value corridor. There has to be a higher death benefit than what your cash value is sitting at. So therefore, whenever you pass away, your death benefit's going to be tax-free with the IUL, as opposed to with the 401k, it's going to be fully taxable, to your beneficiaries. But once again, it has to be set up the right way. Everything that I've been speaking about regarding the IUL might sound like, rainbows and butterflies, and oh my God, it's the perfect product. Unfortunately, these things get set up time and time again the complete wrong way. If you understand the concepts of an IUL, you have to make sure that you're set up with the best company in your area, that you're set up with your exact niche criteria. There's another thing, because this is life insurance, if you're deemed uninsurable, well then that's a problem. Then typically the IUL is not going to be the best course of action for you. This is mainly set up for somebody that has at least somewhat healthy, could at least get a standard or better rating, not somebody that's on their deathbed, because and this is also set up for a longer term contract. With an IUL, you don't want to go and fund this thing for 5 years and then all of a sudden start pulling money from it, because a lot of these contracts are front-end loaded with how they work. So there's a couple of different nuances that you have to understand between one carrier over the next. And unfortunately, an individual might see a television commercial, or might see an advertisement, and say, "Oh, that looks fantastic. I obviously love this cartoon character. I absolutely love this cartoon character. So therefore, I'm going to set up my IUL plan, through this type of company." And it has to be specific to your age, the dollar amount that you're placing, into this type of product, and then also the state that you're in, to see which sort of IUL is, best for your specific needs. There's many scenarios where people are calling into the office. They set up a portion of their monies into the 401k, a different portion into their IULs, and they kind of have the contracts versus each other on what would be the best route for their retirement. But you have to understand that there are some good things regarding IUL. There's some really great things, but there's many times that individuals would throw in thousands of dollars at an IUL plan for many years and then realize they were throwing so much money into fees, and it's not a plan that was originally projected with their illustrations, because they didn't properly understand the negatives with the IUL. In closing, if you found value in this video, I want you to give our 1-800 number a call. It's 1-800-566-1002. Let the assistant know that you've watched the video on the IUL vs 401k explained for dummies, and you want to speak to a specialist. From there, that specialist will be on the line. It could either be myself, it could be another representative, and they're going to try to educate you. They're going to try to see what your goals are, to see whether or not you do have some gaps, within those goals, and how to suffice them properly. An IUL plan might be a great thing for you. It might not be a good thing for you, but you just want to know, you want to be mindful of what might be the best things for your specific situation, and whether or not an IUL plan can fit for your specific needs. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. It's because we go through something known as a Retire Sharp planning system. That on average, when someone gives our 1-800 number a call, we go through over 1,200 top scenarios, strategies, companies, and contracts before we give our top 3 recommendations on what might be the best suited situation for them. Once again, my name is Derek Afasi. I want to thank you very much for watching this video. Please make sure to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. Thank you so much, guys.